The single biggest narrative in crypto isn't a new meme coin or a layer 1, but something that connects the digital world to everything in the real world. BlackRock CEO Larry Fink has said that the next generation for markets, the next generation for securities, will be the tokenization of securities. And he's obviously talking about real world assets. Estimates from firms like Boston Consulting Group predict this could be a $16 trillion market by 2030. But we have heard this before, because for years now, people have said that your house, your art, your stocks, etc. would all be on the blockchain. So is anything different now? And is the real world asset narrative finally here? And what are the risks to your privacy and financial freedom that you don't see talked about a lot by these large financial giants promoting them? Well, that's what we'll be looking at in this video, one of the most important and fastest growing sectors in the entire crypto space, real world assets. As always, nothing contained in this video is financial advice, and let's jump straight in. Firstly, what is real-world asset tokenization? Well, to put it simply, tokenization is the process of creating a digital token on a blockchain that represents ownership of a real-world asset. Think of it like a digital deed or a certificate of ownership. This token proves you own a specific thing, whether that's a physical asset, like a bar of gold, a piece of art, or a fraction of an apartment building, or this can be a financial asset, like a stock, a government bond, or even an invoice from a business. In fact, many people already use the biggest and most successful real-world asset every single day, which is stablecoins. A token like USDC or USDT is just a digital token backed one-to-one by a real-world asset, in this case being pegged to a US dollar. The real-world asset narrative is simply applying that same concept to everything else, hence why the market is predicted to become so big. But what's the point in tokenization? Why take a perfectly good apartment building, for example, or a government bond, and put it on a blockchain? Well, it really comes down to three key advantages. The first is fractionalization. Most people can't afford to buy a $20 million apartment building, let's say, or a $500,000 painting. But what if you could tokenize that building into 20,000 digital shares worth $1,000 each? Because tokenization allows you to break up expensive items into smaller, more affordable pieces, opening up investment opportunities to a much wider audience. The second advantage is liquidity, and this is the one the institutions love. Many of the world's most valuable assets are illiquid, so they're very hard to sell quickly or convert into cash. The main example used to demonstrate this is selling a house, because it normally takes months of paperwork, lawyers, agents, etc. However, by tokenizing it, that asset can be traded on a digital market 24/7 all over the world, which makes it more liquid and unlocks the value tied up in these often illiquid assets. Linked with this is the third advantage, which is efficiency and transparency. Because if we come back to stablecoins again, they're faster and cheaper than traditional payment methods. So instead of paying high fees and having to wait days for a transfer, relying on a dozen middlemen, banks and clearinghouses, all just working Monday to Friday 9 till 5, instead you can use smart contracts. So imagine owning a tokenized rental property. The rent could be collected and automatically paid out to all of the token holders every single month. Or imagine owning a tokenized bond. The interest or coupon payments are just sent directly to your wallet by the smart contract. And given transactions on a blockchain are immutable and transparent to all, this all put together is why people like Larry Fink, the billionaire CEO of BlackRock, are so bullish. It's not about hype, it's about upgrading the entire financial system. So who's actually making this happen? Because this is what's different from what we saw years ago. Now you have the institutional giants getting involved, most of whom were busy ignoring or belittling the space back then. And the biggest signal for this was BlackRock launching its BUIDL fund in 2024, which is a fund on the Ethereum blockchain that represents ownership in US treasuries, that has since expanded to 6 other blockchains, with it launching on Solana's blockchain in March 2025. Franklin Templeton has a similar fund called the Franklin On-Chain US Government Money Fund, using the Benji token on originally the Stellar and Polygon blockchains. This has also now expanded to 9 blockchains at the time of recording this video, with BNB chain being the latest in September 2025. And these obviously aren't crypto startups. They're the largest asset management firms in the world, and they're actively tokenizing financial assets. And this momentum is accelerating. Just recently, JP Morgan announced it's tokenizing a private equity fund on its Connexus platform. Securitize and BNY Mellon have launched a tokenized fund on-chain backed by AAA rated collateral. Fidelity, with its Fidelity Digital Interest Token, or FDIT, which represents shares of the Fidelity Treasury Digital Fund, Vanex BUIDL Fund, and Goldman Sachs, which partnered with BNY Mellon also in 2025 to create a digital asset platform on which to tokenize money market fund shares. So we have to be aware that this is happening now, and it's happening fast, with us just being able to touch the surface in this video. Secondly, you have the crypto native protocols building the infrastructure. So given that tokenized treasuries is the hottest real-world asset category, as we've just seen, protocols like Ondo Finance are helping to lead the charge, allowing crypto users to buy tokens backed by short-term US treasuries. And when you look closer into Ondo Finance, you'll know that it's founded by members from Goldman Sachs and has a close working relationships with BlackRock, so it's definitely part of this system. Oracles are then the critical bridge, because how does the blockchain know the price of gold, for example? Well, it relies on an Oracle network like Chainlink to securely feed that real-world data to smart contracts. Then there are blockchains, which are more tailor-made for real-world assets. For example, Polymesh, which is a blockchain built from the ground up to handle regulated real-world assets, like tokenized stocks, as well as blockchains like Stellar and Algorand, with obviously some being built on Ethereum. And finally, to mention Centrifuge and Quant, who are also heavily involved in the real-world asset space. So the sheer scale of real-world assets sounds promising, but we have to also look at the significant risks. So firstly, centralization, because real-world assets are highly centralized, with crypto being about decentralization. For example, a token for a bar of gold is worthless if you don't trust the custodian who's physically holding that gold in a vault. We only have to go back to 1971 to know that. Also, a token for a house deed is useless if the legal system doesn't recognize that token as true ownership. So this reintroduces the very same middlemen, the same control, and the same counterparty risk that crypto was supposed to eliminate. Secondly, we need to talk about regulation, because the legal and compliance framework for real-world assets is still being built and is unclear. For example, is a token representing a fraction of an apartment a security? Well, yes, it probably is, because it's an investment contract with an expectation of a return. And tokenized financial products like stocks, bonds, treasury bills, money market funds, etc. are very likely to be securities also. However, is a token representing gold in a vault a security? Well, probably not. And how about your house being tokenized and being built on the blockchain, with you owning some of it and a bank, let's say, owning the rest of the tokens? Most of this does seem obvious, but a lot of it's new and needs to be clarified. But if any do fall under the category of being securities, that means they fall under strict regulations from bodies like the SEC in the US or the FCA in the UK. And a single ruling could really affect real-world asset projects here, as we've seen previously with companies being sued, etc., for offering unregistered securities. So let's hope we don't go back to that. The third risk is about privacy, surveillance, and control, because the vision for tokenization unfortunately doesn't stop at assets. There are active plans, like those in the UK, for tokenized digital identities, with the EU being active in this also, in terms of a real-world asset actually being people who will be digitized. And in a best case scenario, this is efficient. You have a token that proves who you are, and you can use it to access services very quickly. But what are the risks, which far outweigh any benefits? Because what happens when every asset you own, your house, your car, your stocks, your money, probably via CBDC, and your ID, are all on a single transparent centralized ledger? Well, that creates the potential for a perfect system of surveillance and control. Your assets could be frozen or seized with a single line of code, with your transactions linked directly to your digital ID, so you could be prevented from accessing certain services or be fined straight away. And this is the dystopian side of the real-world asset narrative. The same tools that promise great efficiency for markets could also be used to enforce unprecedented social and financial control. So what is the future of real-world asset use cases? Well, first is the institutional wave, which is already happening as we've seen. This is the tokenization of traditional financial assets. So bonds and US treasuries like BlackRock's BUIDL fund, private credit and invoices like Centrifuge, equities or tokenized stocks, and commodities like Paxos's PaxG token, which is backed by real gold. This is the multi-trillion-dollar market that BlackRock and the other financial giants are focused on. The second wave is the consumer wave, which is still very much in its early days, but it's where it gets more tangible for an individual. Real estate or property is of course the big one, with companies like Proppy and Realty working on this through fractionalized real estate, but it will take time. Also, there's art and collectibles, allowing fractional ownership of a rare painting or a classic car, for example. Intellectual property, such as tokenizing music royalties, so investors can get a cut every time a song is streamed, and gaming with platforms like Immutable X and Illuvium. So imagine an in-game sword or a piece of land in a metaverse that's a real-world asset. It's not just an item within or inside that game, it's an asset that you truly own and can trade. And we're even seeing this in travel, with the founder of Booking.com recently joining a Web3 travel firm called StainXCom as chairman. Their goal is to reimagine the $11 trillion travel industry around ownership and rewards. And many of these have now created their own narratives. We can even mention industries like energy and healthcare here, for example, which shows how tokenization could eventually touch almost every industry and why it's so huge. So after all of that, if you still see the potential and understand the massive risks, how can you get exposure? Well, you generally have two main ways. The first option is to invest in the tokenized assets themselves. This is the most direct way. You could, for example, buy a tokenized US Treasury, like Ondo's OUSG token, to earn a yield, or buy a tokenized gold token, for example, like Paxos's PaxG. This is like buying the actual asset, just in token form. The second option is to invest in the actual infrastructure. So instead of buying the tokenized gold, you could invest in the protocols that are building the real-world asset ecosystem instead. This includes real-world asset-focused protocols, the oracle that connects them, or real-world asset-specific blockchains. Investing in these tokens is a bet that the trend of tokenization will grow, regardless of which specific asset becomes most popular. So to conclude this video, real-world assets are no longer just hype. The institutional phase of this narrative has definitely begun in a big way. The involvement of BlackRock and other financial giants is the signal. The potential hype from 5 years ago was from crypto-native startups. The momentum today is from the largest financial players around. So the $16 trillion market size potential is very real, but it won't happen overnight. The first, most successful wave of tokenization surrounding financial assets is here to stay, and will likely be a dominant narrative for the next 5 years or so at least. The next wave, tokenizing your house, etc., is more complex on the whole and faces legal and social hurdles, especially when you look at the number of industries represented here. But we have certainly seen some progress, and it will be interesting to see where we are in 10 years, especially if we look at the impact of other narratives like Dystopian and AI. But as always, I'd love to know what you think in the comments below. Is the real-world asset narrative one of the most bullish cases for crypto, or are the risks to privacy and decentralization too high? If you found this video interesting and would like more deep dives like this, please do like the video and subscribe to the channel, as it honestly makes a huge difference. Just a reminder that I do offer one-to-one coaching to those who are genuinely looking to educate themselves in the crypto space, with there being links in the description to contact me and booking a free video call to see if we'd be a good fit. As always, self-custody and the security of people's crypto is key to us at Coin Knowledge as a business focused on education. So holding your assets securely in a hardware wallet, in cold storage in something like a Trezor is key. So you're not leaving it with a third party, but have and hold the digital asset yourself. And I did a review and unboxing of the Trezor Safe 5 hardware wallet, which you can find a link to here and in the description of this video, along with a link to their official website. After doing that, the next crucial step is securing your seed phrase. CryptoTag is the leading and best-selling storage device for that. And I recently did a review of the CryptoTag Zeus model, which again you can find a link to above here and in the description of this video. If you're looking for an easy way to track and stay on top of your crypto investments, you can check out CoinStats, which is the leading cryptocurrency portfolio tracker. And you can find a link to their official website in the description of this video. There's also Coinly, which is one of the best automated crypto tax platforms out there. And you can sign up for a free account with Coinly using the link provided in the video description. If you're looking for more personalized support with your crypto taxes, Miner, a part of the Nephos Group, is one of the leading UK crypto accountancy firms around that provides expert crypto tax advice, as well as other services such as wealth management, restructuring and offshoring. And you'll find a link to contact them directly in the description of this video if you'd like tailored support with your taxes. And for our US viewers, there's a link in the description to contact Crypto Tax Audit, a leading crypto tax company in the United States. So if you need any help with your crypto tax planning, definitely check them out. But thanks for watching, and I'll see you in the next video.